Why great investors think about risk before return. It is the end of a very good year. Your friend is up 38%. You are up 12%. He owns a handful of aggressive investments. You own a portfolio built to survive more than one kind of future. But none of that matters tonight. Tonight, his number is bigger. He smiles when he tells you what he made. He explains that he saw the opportunity early. He tells you he had conviction. He says the people who stayed cautious simply did not understand what was happening. And for a moment, you believe him. You begin to wonder whether caution has become another word for fear. Maybe you should take more risk. Maybe your portfolio is too conservative. Maybe the market has changed and you have failed to change with it. Then something happens 6 months later. The same investments that made him look brilliant begin to fall. At first, the decline is small. Then it becomes uncomfortable. Then violent. The gain that looked like proof of skill begins to look different. And a question appears that is much harder than asking who earned the highest return. How do you know whether you are looking at skill, or merely risk that has not collected its bill yet? That question sits near the center of Howard Marks's investing philosophy. Marks is the co-founder of Oaktree Capital Management. Before Oaktree opened its doors in 1995, he spent years working in high-yield bonds, convertible securities, and distressed debt. These were markets where the promise of return could never be separated from the possibility of loss. His book, The Most Important Thing, is not built around a formula that tells you exactly what to buy. It is built around a way of thinking. Second-level thinking. The relationship between price and value. Cycles. Contrarianism. Patient opportunism. And above all, risk. This is not a video about being afraid of the market. This is not a video about avoiding every loss. This is a video about why surviving bad outcomes may matter more than chasing spectacular ones. And we will return to the question from that dinner table. Because the highest return in a good year tells you less than you think. Sometimes the real test begins only when conditions turn against you. Howard Marks wrote his first investment memo in 1990. The idea at its center was already revealing. Instead of trying to build a great record through a series of spectacular years, Marks argued for something quieter: avoid disastrous losses, remain consistent, and let long-term results emerge from survival. That sounds almost too modest for Wall Street. The investment world loves winners. The stock that doubled. The fund that ranked first. The manager who made the call nobody else made. We are drawn to upside because upside is visible. Risk is different. Risk can hide. You can take too much of it and look brilliant for years. You can borrow money and watch debt magnify your gains. You can buy the most popular assets in a rising market and appear to possess extraordinary insight. You can concentrate your portfolio and enjoy returns that diversification could never match. Until the environment changes. Then the same choices that created the upside begin to explain the damage. This is why one of the most dangerous periods for an investor can be the period immediately after success. Success teaches lessons. But it does not guarantee that the lessons are correct. Imagine a portfolio manager named David. He is a composite, not a real person. David begins with $100 million. He wants to outperform. So he invests more aggressively than his peers. He owns the fastest growing companies. He uses a little borrowed money. He reduces cash. He avoids the boring assets that might protect him but also slow him down. The market rises. David has a fantastic year. Clients send more money. Financial media ask him to explain his philosophy. His decisions now have a story attached to them. He was bold. He understood the future. He did not allow fear to hold him back. The next year, the market rises again. David's confidence grows. But notice what has not yet happened. His risk has not been tested. A strategy can look intelligent when the environment rewards exactly the kind of risk it contains. That does not mean the strategy is bad. It means the evidence is incomplete. Here's the part most people miss. Return is an outcome. Risk is partly the set of possibilities that existed before you knew the outcome. Once the coin has landed, it is easy to forget that another result was possible. You see the person who won and build a theory around the victory. You rarely see the alternate version of the same decision. The version where the market fell. The version where financing disappeared. The version where a company missed one quarter and the valuation collapsed. The version where borrowed money forced a sale at the worst possible moment. This is why investing wisdom requires more than reading results backward. It requires thinking forward from uncertainty. The Greeks had a word for practical judgment, phronesis. Not intelligence in the abstract. Not the ability to solve the hardest equation. Practical wisdom under imperfect conditions. That is close to what Marx means when he talks about second-level thinking. First-level thinking sees a good company and says, this is a good investment. Second-level thinking asks something harder. Is the company better than the market already expects? What is embedded in the price? What does everyone else believe? If the consensus is right, how much of that good news has already been paid for? And what happens if reality is merely good instead of extraordinary? This changes the nature of investing. You are no longer trying only to identify what is good. You are trying to understand the relationship between what is good, what is expected, and what is already reflected in the price. A wonderful business can become a terrible investment if the price assumes perfection. A troubled business can become an attractive investment if the price assumes disaster and reality turns out to be merely difficult. That is why Marx's world is not divided neatly into good assets and bad assets. Price matters. Expectations matter. Position in the cycle matters. And risk changes as those things change. Consider what happens late in a long bull market. Prices have been rising. Credit is easy. Volatility has been low. Recent memories are pleasant. People who took risk have been rewarded. People who remained cautious have fallen behind. What does that environment teach the crowd? That risk is low. But what might it actually be doing? Encouraging investors to accept more risk precisely because they feel less afraid of it. This is one of the great paradoxes of markets. When everyone feels safe, prices can become expensive, standards can weaken, and future returns can become less attractive. When everyone feels terrified, prices can fall, forced sellers can appear, and future returns may improve. The feeling of risk and the amount of risk are not always moving in the same direction. But it runs deeper than that. Risk is difficult because you cannot always see it before it arrives. A cracked bridge is easy to fear. A bridge that looks perfect but was built with weak steel is more dangerous because it invites confidence. Markets often work the same way. The absence of recent losses can make investors believe the system has become safer. But sometimes the absence of visible damage allows hidden fragility to grow. More borrowing. Lower standards. Higher prices. More optimism. Less room for disappointment. Marx built much of Oaktree's philosophy around risk control because he understood a simple asymmetry. A severe loss is not merely the opposite of an equally large gain. If you lose 50%, you need a 100% gain to get back to where you started. Damage changes the mathematics. And some losses do more than reduce capital. They remove your ability to continue. Debt can force you to sell. A liquidity problem can turn a temporary decline into a permanent loss. A concentrated mistake can consume years of previous progress. This is why avoiding ruin deserves more attention than it usually receives. Investors love to ask how much they can make. A thoughtful investor also asks what can make participation impossible. There is a Latin idea that fits here, via negativer. Improvement through removal. In investing, you do not always become stronger by adding more return. Sometimes you become stronger by removing ways to die. Less borrowed money. Less dependence on a single outcome. Less need for perfect timing. Less exposure to risks you do not understand. Less pressure to match someone else's spectacular year. That may not look ambitious. But survival is what gives compounding time to work. Imagine two investors. The first earns 20% in year 1 and then loses 50% in year 2. The second earns 8% in both years. The first investor had the more exciting year. The second investor ends the 2-year period with more money. That simple example captures something markets repeatedly hide from us. The path matters. The sequence matters. The losses matter. And the best long-term investor is not automatically the person who wins the most in the easiest environment. Sometimes it is the person who loses the least when the environment becomes hostile. This is why Marx has emphasized that skill should be judged across both good markets and bad ones. A manager who shines only when risk is rewarded may simply own more risk. You learn much more when the tide turns. What survives? What breaks? Who still has capital? Who still has the emotional ability to act? If you enjoy quiet conversations about money, judgment, and the ideas behind lasting wealth, consider subscribing to Relax Audiobooks. Because the next part is where risk control becomes more than defense. It becomes the source of opportunity. When people hear the word defensive, they often imagine hesitation. Cash sitting unused. Opportunities missed. A person too afraid to act. That is not what Marx is describing. True defensiveness is preparation. You accept that bad periods will come. You do not know exactly when. You do not know what will trigger them. But you structure your decisions so that you can still think when other people are forced to react. That matters because the best opportunities often appear when someone else has lost the ability to wait. A fund faces redemptions. An indebted investor receives a margin call. A bank needs to reduce exposure. A frightened individual decides they cannot tolerate another day of losses. Assets are sold not because their owners believe the price is attractive, but because they need liquidity. The thoughtful investor wants the opposite position. Not forced. Not desperate. Not dependent on the next hour. Patient. This is patient opportunism. You do not have to swing at every pitch. You do not have to manufacture an opportunity because you are bored. You can wait. And waiting is much harder than it sounds. When markets rise for a long time, patience feels like incompetence. Cash feels useless. Caution feels expensive. Everyone else appears to be moving forward while you stand still. Then the cycle turns. Suddenly patience acquires a price. The investor who preserved liquidity can buy from the investor who did not. The investor who refused excessive borrowing can think while the indebted investor must sell. The investor who accepted lower returns in the easy period may gain choices in the hard period. Risk control did not eliminate opportunity. It preserved the ability to use it. There is an ancient Greek word, kairos. It means the right or opportune moment. Investing contains long periods when the correct action is not dramatic. Study. Wait. Maintain discipline. Then conditions change. Prices move far enough. Fear becomes widespread enough. The relationship between risk and possible reward improves. And the patient investor is able to act because patience preserved both capital and judgment. But there is a trap here. Contrarianism. People hear that great investors go against the crowd, so they assume the opposite of consensus must be intelligent. It is not. If everyone says a bridge is broken and you cross it simply because you want to be contrarian, you are not thinking independently. You are reacting to the crowd just as much as the person following it. Marx's idea is subtler. You need a view that differs from consensus and you need a reason that your view is more accurate. Being different is not enough. You have to be different and right. That is difficult. Which is why second-level thinking begins with humility. You ask what the consensus believes. You ask what the price implies. You ask what would have to happen for your view to be correct. Then you ask the uncomfortable question. Why should you know something the market does not? Sometimes there is an answer. Specialized knowledge. Better analysis. A longer time horizon. The ability to tolerate temporary discomfort. A seller who is acting for reasons unrelated to value. But sometimes there is no answer. Sometimes your contrarian opinion is simply an opinion. Knowing the difference is part of risk control. There's a second layer to this. Risk does not come only from what you own. It comes from how much confidence you place in what you think you know. A forecast can be wrong. A valuation can be wrong. A cycle can last longer than expected. A cheap asset can become cheaper. A strong company can encounter a problem you did not imagine. The danger grows when your portfolio leaves no room for those possibilities. Marx repeatedly returns to the importance of knowing what you do not know. That is not an argument for paralysis. It is an argument for proportion. The less certain you should be, the less your survival should depend on being right. This is where the story becomes personal. Imagine your portfolio has been cautious for 2 years. Markets have risen without you as much as you hoped. Your aggressive friend has done better. Every month becomes a small humiliation. You see his returns. You see the headlines. You see people explain why the old risks no longer matter. Then your own mind begins to negotiate with you. Maybe the environment really has changed. Maybe caution is outdated. Maybe risk control is preventing success. You increase exposure. Then increase it again. Not because your analysis became better. Because watching someone else win became painful. This is one of the negative influences Marx warns investors about. Envy. Fear of missing out. The desire to belong to the successful crowd. The emotional need to make back relative underperformance. These forces rarely appear in spreadsheets. But they can control portfolios. Now imagine the market turns 1 month after you finally give in. This is where our opening question returns. Your friend had the highest return. You felt foolish. He looked skilled. But now prices are falling. Liquidity is disappearing. The positions that seemed unstoppable are suddenly difficult to sell. And for the first time, you can observe what the previous returns were hiding. Risk. Now here's where it gets uncomfortable. Risk is easiest to recognize after it has already hurt someone. Before the loss, it often looks like extra return. Borrowing looks like efficiency. Concentration looks like conviction. Illiquidity looks like patience. A high valuation looks like confidence in a great company. Then the cycle turns and the labels change. This is why you cannot build a risk process only around what happened last time. The next source of damage may look different. You need a deeper principle. Do not ask only whether an investment can make money. Ask what assumptions must remain true for you to survive owning it. Ask what happens if financing disappears. Ask what happens if the price falls 30% while your thesis remains unresolved. Ask whether you will be forced to sell. Ask whether the position is large enough to threaten the rest of your plan. Ask whether you understand the risk or merely recognize the return. That is second-level thinking applied to survival. And now we can answer the question from the beginning. How do you know whether you are looking at skill or merely risk that has not collected its bill yet? In real time, you often cannot know with certainty. That is the point. A great year is not enough. A smooth market is not enough. A backtest is not enough. You need time. You need different environments. You need to see what happens when optimism becomes fear. You need to see whether the process can survive the full cycle. The most revealing evidence often arrives in the period nobody wanted. A downturn. A credit contraction. A panic. A moment when holding risk becomes painful. That is when hidden debt exposure becomes visible. That is when weak underwriting appears. That is when the investor who confused a rising market with personal brilliance discovers the difference. The goal is not to predict every bad period. It is to build a way of investing that does not require perfect prediction. Sit with that for a second. Risk control is not the opposite of return. It is the protection of your ability to earn returns in the future. Every dollar you do not permanently lose remains available to compound. Every crisis you survive leaves you present for the recovery. Every time you avoid being forced to sell, you preserve the freedom to decide. This is why the best defense can become a form of offense. The investor with liquidity during panic has choices. The investor with modest debt has time. The investor who expected cycles is less surprised when one arrives. The investor who did not need every year to be spectacular can act when spectacular opportunities finally appear. Notice what just happened. The question changed. At the beginning, you were comparing 12% with 38%. You wanted to know who was better. Now the question is not who won 1 year. It is who built a process capable of staying alive through many years. That is a much harder competition. And a much more meaningful one. If this way of thinking about investing helps you, consider subscribing to Relax Audiobooks for more calm explorations of money, markets, and long-term judgment. Before we finish, there are 3 things worth remembering. First, return without context tells you very little about skill. A high return may reflect insight. It may also reflect borrowing, concentration, favorable conditions, or simply luck. To judge a process, you have to look at the risks that were taken and observe how it behaves across different environments. Second, risk control creates options. Cash, diversification, reasonable position sizes, disciplined underwriting, and modest debt can look inefficient when markets are easy. But they preserve your ability to think and act when conditions become difficult. The point is not to avoid all risk. The point is to take risk in forms and amounts you can survive. Third, the most dangerous risk is often the one that feels safest. When prices rise, when credit is abundant, when everyone agrees, and when recent history has been kind, caution becomes hardest to maintain. That is precisely when you should remember that risk does not need to announce itself before it arrives. So here is the question I would leave with you. When you look at your best investment result, can you explain not only why it worked, but what could have made it fail? If you cannot, you may understand the return better than you understand the risk. Howard Marks called his book The Most Important Thing, then filled it with many things that seemed to deserve the title. Second-level thinking. Price and value. Cycles. Contrarianism. Patience. Luck. Defense. That was not a contradiction. It was the lesson. Investing is a system. Risk does not live in one number. It lives in the relationship between price, expectations, behavior, debt, time, uncertainty, and your own ability to endure. The market will always offer you someone with a better recent return. Someone more confident. Someone who appears to have discovered a faster path. You do not have to beat them this year. You have to build something that can still be standing when the year nobody expected finally arrives. Because wealth is not only created by the gains you capture. It is also created by the losses you never have to recover from.